They didn't ring a bell. They didn't make an announcement. They waited until liquidity was thin, books were closing, and most people were asleep. At 2:14 a.m. New York time, silver surged past a level many believed would never be touched again. $72. Not in a frenzy of retail buying, but in silence. And here's the part that should stop you cold. Banks were buying. Panic buying. Why would the institutions that spent decades suppressing volatility suddenly chase the market higher? What happens when the people who control the exits are the ones running for the door? Stop waiting. Stop assuming this is just another spike. To understand why this move matters, we need to go back to a system built on promises, not metal. To understand what just happened, we need to separate price from reality. For years, silver has existed in two worlds. The first is the world you see on a screen: futures contracts, ETFs, paper claims. In this world, silver trades like a number, liquid, abstract, endlessly rehypothecated. 1 ounce can be sold dozens of times without ever moving. The second world is physical silver: bars, blanks, industrial feedstock. This silver must be mined, refined, transported, and delivered. It cannot be created with a keystroke. The problem is that the modern silver market was designed as if the first world could permanently dominate the second. Banks, refiners, and large traders built a system based on hedging. Refiners sell futures contracts to lock in prices. Banks intermediate those trades, providing liquidity and leverage. As long as prices move slowly, the system works. But when prices move fast, the system demands collateral, margin. And margin doesn't care about narratives or intentions. It demands cash immediately. Over the past several years, physical silver has been quietly tightening. Industrial demand from solar panels, electronics, and electrification has grown steadily. At the same time, new mine supply has struggled to keep pace, while recycling remains limited and slow. This created a fragile equilibrium: plenty of paper silver, but increasingly scarce deliverable metal. Most people never noticed because price stayed contained until it didn't. And when price breaks during the least liquid time of the year, late December, the consequences are amplified. Thin order books turn small imbalances into violent moves. That's why this isn't just about $72. It's about timing, structure, and a system that was never built to handle stress. So what actually caused the squeeze to ignite? What happened at $72 was not an accident. It was the result of several forces colliding at the worst possible moment. Let's break them down, one by one. 1. The refiner's trap. When hedging turns into a weapon. Most people believe refiners are protected when prices rise. In reality, they are often the first to bleed. Here's why. Refiners typically hedge their future production by selling silver forward in the futures market. On paper, this locks in revenue and stabilizes cash flow. But those short futures positions come with a hidden risk: margin exposure. When silver moves slowly, margin requirements remain manageable. But when price jumps aggressively, like it did into year-end, margin calls arrive fast and without mercy. A move from $68 to $72 doesn't just change valuation. It can demand tens of millions of dollars in additional collateral overnight. If that cash isn't immediately available, positions must be closed. And closing a short position means buying silver at any price. This is how hedging becomes forced buying. And when multiple refiners face the same pressure at once, the squeeze feeds on itself. 2. Christmas liquidity. The market's weakest moment timing was everything. Late December is when liquidity is thinnest. Trading desks are understaffed. Risk limits are tightened. Books are being closed, not expanded. In this environment, even modest buying pressure can cause outsized price moves. Now imagine margin calls hitting refiners at exactly this moment. They are not negotiating. They are not optimizing. They are executing under duress. Every market has moments of weakness. This was silver's, and someone knew it. 3. Industrial demand doesn't care about price. Unlike speculative demand, industrial demand is stubborn. Solar manufacturers don't shut down lines because silver gets expensive. Electronics producers don't redesign circuits overnight. Supply chains move forward even when prices scream, "Stop." That means there was no natural seller stepping in to absorb the shock. Instead, buyers kept coming, while sellers vanished. This is the definition of a squeeze. 4. Paper claims versus deliverable metal. Finally, the most uncomfortable truth. The silver market trades far more claims than metal. Most contracts are never meant to be settled physically, but when confidence cracks, behavior changes. More participants demand delivery. More players question counterparty risk. And suddenly, what was once a paper game collides with physical limits. At that point, price no longer reflects balance, it reflects stress. And stress is contagious. This wasn't speculation running wild, it was structure failing under pressure. So, what happens next? When this stress spills beyond one market and into the global system? Silver is not a local market, it is a global artery. And what just happened exposed how fragile that artery has become. The United States consumes far more silver than it produces. A significant portion of the metal used in electronics, defense systems, and renewable energy must be imported. Meanwhile, refining capacity is heavily concentrated in Asia, with China playing an outsized role in processing and downstream supply. Europe faces a similar vulnerability. London remains the world's largest paper-silver hub, yet much of the metal backing those contracts is neither moving nor easily accessible on demand. The result is a geographic mismatch. Claims in the West, metal in the East. When stress appears in one node, New York futures, London clearing, it doesn't stay there. It transmits through supply chains. Manufacturers feel it first. Rising silver prices increase input costs for solar panels, power electronics, and medical equipment. Margins compress. Projects are delayed. Some are quietly shelved, then the effects spread outward. Higher production costs feed into consumer prices. Governments face pressure to subsidize strategic industries. And central banks, already managing inflation expectations, find another variable slipping out of control. History shows that commodity squeezes rarely remain isolated. They distort trade flows, strain diplomatic relationships, and force policy responses that arrive too late. What began as a pricing anomaly now threatens to become something larger, a credibility test for markets built on leverage and trust. And that leads to the question policymakers and investors are now asking, often privately. How do you respond when a market stops behaving? There are no clean solutions, only trade-offs. For investors, the lesson is structural. Exposure to silver is no longer just about direction, it's about form. Paper instruments behave differently under stress than assets tied to deliverable supply. Understanding that distinction is no longer optional. For industrial users, the response will likely involve longer-term contracts, inventory rebuilding, and accelerated investment in recycling. But these adjustments take time, measured in years, not quarters. Governments face harder choices. New mines require a decade or more to come online. Strategic stockpiles can be released, but only once. Regulatory intervention, raising margin requirements, limiting position sizes, may cool volatility, but it doesn't create metal. That leaves us with scenarios, not certainties. In the short term, volatility remains elevated. Sharp pullbacks are possible, but they will be fragile. Each dip tests whether forced sellers are exhausted or merely catching breath. In the longer term, the trajectory depends on trust. If market participants continue to question whether paper claims can be honored, pricing will adjust accordingly. Not explosively, persistently. And once a market reprices trust, it rarely returns to its old range. This was never just a price move. $72 was a signal. A line crossed when liquidity vanished, margins snapped, and institutions were forced to reveal their hand. When banks begin panic buying, the market is no longer functioning on confidence. It's functioning on necessity. History is clear about moments like this. They don't end with relief, they end with repricing. If you're still waiting for the perfect pullback, you may already be behind the curve. This is not the phase where patience is rewarded. It's the phase where understanding matters. Share this. Study the structure. And ask yourself one final question. When trust breaks, what do you actually own?